Have you ever wondered what would happen if the United States just didn't pay its bills? I'm not talking about you missing a credit card payment. I'm talking about the biggest economy in the world defaulting on trillions of dollars in debt. Here's what nobody tells you. This isn't some theoretical doomsday scenario that economists debate in ivory towers. We've come dangerously close to this happening. Multiple times. And the consequences would be so catastrophic that most people can't even wrap their heads around it. Here at Simple Money, we've spent time analyzing what actually happens when governments default on debt. And today, I'm going to reveal something that might completely change how you think about money, government spending, and your own financial security. So here's what's really happening. The U.S. government owes over $33 trillion. That's trillion with a T. To put that in perspective, if you spent $1 million every single day, it would take you over 90,000 years to spend $33 trillion. Now, most people hear that number and think, well, that sounds bad, but the government always figures it out, right? And technically, yes. So far they have. But here's the part that should terrify you. The U.S. government doesn't just owe money, it owes money to everyone. Your grandmother's Social Security? That's government debt. Your 401k that holds treasury bonds? Government debt. Foreign countries like China and Japan? Massive holders of government debt. And here's where things get interesting. Unlike you or me, the government can't just declare bankruptcy and start over. When the United States borrows money, it promises to pay it back, and the entire global financial system is built on the assumption that the U.S. always keeps its promises. Think about it this way. Imagine you're the person everyone knows is totally reliable. You always pay people back, you never miss a deadline. People lend you money without even thinking about it because you're that trustworthy. Now, imagine you suddenly stop paying people back, not because you don't have the money, but because you just decide not to. What happens to your reputation? What happens to your ability to borrow money in the future? What happens to all the people who were counting on you? That's what a U.S. debt default would be like. Except multiply the consequences by 1 trillion. Let me walk you through what would actually happen if the U.S. defaulted on its debt, and I'm going to explain the 5 stages of financial chaos that would unfold, each one worse than the last. The first stage is what I call the trust collapse. Here's what most people don't realize. U.S. Treasury bonds aren't just investments. They're the foundation of the entire global financial system. They're considered the safest asset in the world. Safer than gold, safer than cash under your mattress, safer than anything. Banks use them as collateral. Pension funds rely on them for stable returns. Foreign governments hold them as reserves. The interest rate on these bonds determines the interest rate on basically everything else in the economy. When I say they're the foundation, I mean it literally. Every other investment is priced relative to treasury bonds. They're called risk-free assets because the assumption is that the U.S. government will always pay you back. Now, what happens when that assumption breaks? The moment the U.S. misses even one payment, every treasury bond in existence becomes suspect. If they missed one payment, why wouldn't they miss another? Suddenly, the safest investment in the world becomes a question mark. And here's where things get interesting. When investors lose confidence in U.S. debt, they don't just sit around waiting to see what happens next. They sell fast. Think of it like a fire in a crowded theater. The first person who smells smoke and heads for the exit? They get out fine. But when everyone realizes there's a fire at the same time, people get trampled. Panic takes over. In financial markets, this happens in milliseconds. Computer algorithms detect the default. They automatically start selling treasury bonds. Other algorithms see the selling and join in. Within minutes, you have a cascade of selling that nobody can stop. The price of treasury bonds would plummet. And when bond prices fall, interest rates skyrocket. This isn't just bad for the government. This affects you directly. Your mortgage? That interest rate is based on treasury bonds. Your car loan? Same thing. Credit cards? You guessed it. Student loans? All of them. Overnight, borrowing money would become massively more expensive for everyone. The second stage is what I call the credibility crisis. Here's something that might blow your mind. The US dollar isn't backed by gold anymore. It hasn't been since 1971. So what backs the dollar? Trust. That's it. Trust in the S. Government. The dollar is valuable because people believe the U.S. government is stable, powerful, and will honor its commitments. That belief is what makes the dollar the world's reserve currency. It's why international trade is conducted in dollars. It's why countries hold dollars as reserves. But what happens when the US government proves it won't honor its commitments? The dollar would collapse, not slowly, not gradually. We're talking about a potential drop of 30 to 40% in value within weeks. Think about what that means for your life. Every dollar you have saved just lost a third of its value. That vacation you were saving for now costs 50% more. That retirement fund you've been building just got decimated. But here's what makes this even more insidious. You can't escape it by buying foreign currency fast enough, because the chaos would spread globally. When the world's largest economy implodes, everyone feels it. Foreign governments would start dumping their dollar reserves. They'd need to, because holding dollars would mean holding something that's rapidly losing value. This creates a feedback loop. More selling means lower value. Lower value means more panic. More panic means more selling. China, Japan, and other countries hold over $7 trillion in US debt. If they all tried to sell at once, there wouldn't be enough buyers. The market would freeze. The third stage is what I call the banking apocalypse. Here's what nobody wants to admit. Banks don't actually have your money. Not all of it, anyway. They have some of it, but most of it is invested in things like treasury bonds. Banks are required by law to hold safe assets. And for decades, treasury bonds were the definition of safe. So banks loaded up on them. Your local bank, the big Wall Street banks, all of them. When treasury bonds become worthless or even just questionable, banks face an immediate crisis. Their assets just evaporated, but their liabilities, the money they owe to depositors like you, haven't changed. This is called a solvency crisis. The bank doesn't have enough assets to cover its liabilities. And when people figure this out, they rush to withdraw their money before the bank runs out. Remember Silicon Valley Bank in 2023? That was a small taste of what we're talking about. Except instead of one bank failing, you'd have dozens, maybe hundreds, all at once. The Federal Deposit Insurance Corporation, the FDIC, insures deposits up to $250,000 per account. But here's the problem. The FDIC doesn't have enough money to handle multiple large banks failing simultaneously. In a full-scale banking crisis triggered by a debt default, the FDIC would be overwhelmed within days. Your deposits might technically be insured, but good luck actually getting your money when the system is collapsing. And here's where things get really interesting. When banks fail, lending stops. Completely. Banks that are struggling to survive don't make new loans. They call in existing loans. They hoard cash. This means businesses can't make payroll. They can't buy inventory. They can't expand. They can't even operate normally. So they start laying people off, shutting down, going bankrupt. The fourth stage is what I call the economic freefall. Let's talk about what happens to the actual economy, the real world where people work and buy things and pay bills. Government spending would have to stop immediately. Not slow down, stop, because if the government can't borrow money, and it's not bringing in enough tax revenue to cover expenses, it has to cut spending, dramatically. Social Security checks? Delayed or reduced. Medicare payments? Same thing. Military salaries? Government contracts? All of it gets cut or stopped. Now, you might think, well, maybe the government should spend less anyway. And that's a fair philosophical debate. But we're not talking about a planned, gradual reduction. We're talking about an immediate, catastrophic halt. Think about how many people depend on government payments. 66 million Americans receive Social Security. Tens of millions more receive Medicare. Millions of government employees and contractors, all of these people suddenly have their income disrupted. These people have rent to pay, mortgages, car payments, groceries to buy. When they stop receiving money, they stop spending money. And when millions of people stop spending simultaneously, the economy grinds to a halt. Businesses that sell to these customers see revenue drop, so they lay off workers. Those workers stop spending. More businesses suffer, more layoffs. It's a death spiral. Unemployment would spike, not to 8 or 10% like in a bad recession. We're talking about potentially 20, 25, even 30% unemployment. Great Depression levels. And here's what makes this even more cruel. The people who get hurt the most are the ones who can least afford it. The working class, the middle class, the people living paycheck to paycheck. The wealthy can weather the storm. They have assets, diversification, resources. But the average person? They're devastated. The fifth stage is what I call the global contagion. Here's something that might shock you. A U.S. debt default wouldn't just hurt America. It would trigger a global economic crisis that would make 2008 look like a minor hiccup. The United States represents about 25% of global GDP. When the U.S. economy collapses, it takes everyone else down with it. American consumers are the biggest buyers of products from China, Europe, Mexico, and dozens of other countries. When Americans stop buying, those countries go into recession. Their workers get laid off. Their economies contract. But it's worse than that. Remember how I said the dollar is the world's reserve currency? That means global trade depends on dollars. Oil is priced in dollars. International contracts are denominated in dollars. Central banks hold dollars. When the dollar collapses, global trade seizes up. Ships sit in ports because no one knows what currency to use for payment. Supply chains break down. Shortages develop. Prices for basic goods skyrocket. And here's where things get really dark. Economic chaos leads to political chaos. When people can't feed their families, they get desperate. They get angry. They look for someone to blame. History shows us what happens during economic collapses. Political extremism rises. Authoritarian leaders gain power. International conflicts escalate. It's not a coincidence that World War II followed the Great Depression. I'm not saying a U.S. debt default would automatically trigger a world war, but it would create the conditions that make conflict more likely. Desperate nations do desperate things. Now, let me tell you about two people, Sarah and Mike. They're both in their 30s. Both have decent jobs and some savings. Both hear about the possibility of a debt default on the news. Sarah sees the headlines and thinks, "That sounds bad, but the government always figures it out. I'm sure they'll raise the debt ceiling like they always do." She doesn't change anything about her financial life. She keeps her money in a regular savings account, earning barely any interest. She doesn't diversify. She doesn't prepare. Then one day, the unthinkable happens. Political gridlock prevents Congress from raising the debt ceiling. The U.S. misses a payment. Markets panic. Sarah watches her savings lose value as the dollar crashes. Her bank becomes insolvent. Her employer, which relied on government contracts, lays off half the staff, including her. She can't access her money. She can't pay her bills. And she's completely unprepared because she thought it could never actually happen. Now let me tell you about Mike. Mike hears the same news about the debt ceiling, but instead of assuming it'll work out, he asks himself, what if it doesn't? He starts diversifying his savings. He keeps some cash at home in case banks close. He moves some money into assets that hold value when currencies collapse. Not all of his money. He's not a doomsday prepper, but enough to have options. He builds an emergency fund that could last 6 months without income. He reduces his debt so he's not vulnerable to rising interest rates. He learns skills that would be valuable even in a crisis economy. When the crisis hits, Mike isn't happy about it, but he's not devastated either. He has options. His diversified assets protected some of his wealth. His emergency fund keeps him afloat. His low debt means he's not drowning in payments he can't afford. The difference between Sarah and Mike isn't that Mike was smarter or luckier. It's that Mike understood something crucial. He understood that just because something hasn't happened yet doesn't mean it can't happen. Here's what most people don't realize. The question isn't whether you believe a U.S. debt default will happen. The question is whether you're prepared if it does. And here's the uncomfortable truth that nobody wants to talk about. The U.S. has been playing an increasingly dangerous game with its debt. The national debt has been growing faster than the economy for decades. Political polarization makes it harder to reach agreements on the debt ceiling. We've had multiple close calls already. At some point, the close calls run out. At some point, the political brinkmanship goes too far. And when that happens, it won't matter if you believed it was impossible. But here's where things get really interesting. Understanding the risk of a debt default isn't just about preparing for catastrophe. It's about understanding how the entire financial system actually works. Most people think money is real, solid, backed by something tangible. But modern money is backed by trust, by institutions, by the collective belief that governments will honor their commitments. When you understand this, you start making different choices. You don't put all your trust in any single system. You diversify. You prepare for multiple possible futures. You think about resilience, not just returns. This isn't paranoia. This is financial maturity. It's understanding that the systems we take for granted are more fragile than we want to admit. The people who thrive through financial crises aren't the ones who predicted exactly when it would happen. They're the ones who prepared for the possibility, who built resilience into their financial lives, who understood that hope is not a strategy. Think about it this way. You have insurance for your house, even though you don't expect it to burn down. You wear a seatbelt, even though you don't expect to crash. You prepare for unlikely but catastrophic events because the cost of being wrong is too high. A U.S. debt default is the same thing. Unlikely? Maybe. Impossible? Definitely not. Too catastrophic to ignore? Absolutely. So what does preparation actually look like? It's not about building a bunker and hoarding gold coins. It's about smart, practical steps that make you more resilient regardless of what happens. Keep multiple months of expenses in cash, not just in the bank. Actual cash you can access if ATMs stop working. Build real emergency funds, not just the minimum. Reduce debt aggressively so you're not vulnerable to interest rate spikes. Diversify your assets across different types of investments and different currencies. Learn valuable skills that would matter in any economy. These aren't radical steps. They're just good financial practice, but they become critical when systems break down. Here's the key insight that changes everything. Financial security isn't about predicting the future. It's about being prepared for multiple possible futures. The future where everything works out fine, and the future where systems fail. The difference between financial fragility and financial resilience is whether you've thought through the what-ifs, not obsessively, not fearfully, but honestly and practically. A U.S. debt default would be devastating. Make no mistake about that. But it wouldn't be the end of the world. Economies recover. Systems get rebuilt. Life goes on. The question is whether you've positioned yourself to survive and eventually thrive through that recovery. The trust collapse, the credibility crisis, the banking apocalypse, the economic freefall, and the global contagion aren't inevitable, but they're possible. And possibility demands preparation. The choice isn't whether to believe a default will happen. The choice is whether to be ready if it does. Because the cost of preparing for something that doesn't happen is minimal. But the cost of not preparing for something that does happen is catastrophic. The government might raise the debt ceiling next week, next month, next year. They probably will. They have every time before. But probably isn't the same as definitely. And your financial security is too important to bet on probably. So here's the question I want you to sit with. Not whether you think a U.S. debt default will happen, but whether you're prepared if the impossible becomes reality. Because in financial markets, the impossible has a funny way of happening more often than we'd like to admit.